everyone. Welcome back. You're watching Insight. Right now, we're joined by Heather Foster with Foster Financial, always bringing us those great financial tips. A pleasure to always have you here, Heather. Heather, today we're talking about that planning and choosing the right beneficiary. Let's break it on down and talk about it.
Yeah, because still money's money, right?
Yeah.
So do you want to pay more in taxes? Probably not. Do you want to pay more in legal fees? Potentially if you don't have beneficiaries listed at all. So part of our planning process that we do, and everyone that comes through our door, when we go through the planning process, they're like, oh, I know I've got my beneficiary set up correctly. There's names on everything.
Yeah.
But we always do a deep dive as a part of our planning process where we call every company. We call on pensions to see if there's survivor benefits. We call on every investment company that they have. We call on even their banks, and we verify who is your primary and who are your contingents. And 99.9% of the time, we at least find one deficiency in at least one account. So what that means, though, if you don't have the beneficiaries listed, first of all, then that means it's probably going to go through probate. So if it goes through probate, then hopefully you've got a will at least, but some people don't even have a will.
Right.
They haven't worked with a legal professional or an attorney to drop those legal documents. So it could go through probate. It could, get intestate where people can fight over your money. You don't want any of that. Plus, you don't want the ability for people to pay taxes on money that they could have potentially deferred taxes over a period of time. Something like an IRA account, if you've missed putting a beneficiary on there, they may have to cash it out right away and then pay a lot more in taxes, up to 40% or so in federal taxes if they didn't list that beneficiary. But if they had listed a beneficiary, the person could have stretched that tax liability out over a 10-year period if they're more than 10 years younger, or if they're within a 10-year age bracket, they can actually do a stretch IRA, which goes over their lifetime. So the tax side of it is quite large, as well as like doing things like putting assets into an irrevocable trust. It locks the cost basis in. So most of the time, and again, you will work with a legal professional on this, making sure you understand when you do legal documents and how you set up the beneficiaries within even the legal documents has an effect on how those beneficiaries will pay taxes. The other thing is listing a charitable organization. I see this all the time where people list a charity in their will, but then they leave all their IRA money or their pre-tax money to their family members. And that's really backwards, because the kind of money that will go through a will is typically what we call after-tax funds, which is something like selling your house, which isn't taxable anyways. So you're leaving those charities tax-free money, and you're leaving your family what we call like tax-infested money that's never been taxed before. And if you reverse that and list your charitable organizations on your IRA as a beneficiary, and then you exclude them from potentially the will, and you list your family members in the will, your family is now receiving all the tax-free money. Your charities are receiving taxable money, but they get a special exclusion. They get that money tax-free. So one, we see deficiencies all the time with people forgetting to list. Maybe they listed a primary and they forgot the contingent. But what if you and your spouse got in an accident at the same time? That goes through the contingents, and if there's no contingents listed, you're looking potentially at probate. So one, you can save yourself a lot of money in legal fees by not allowing assets to go in to an estate and potentially be probated, as long as you have a will and your beneficiary set up correctly. Two, the right kind of beneficiaries on the right kind of accounts. Meaning, make sure you leave that tax-infested money to the charitable organizations, because they can get it tax-free. List your family members to get all the tax-free money and the Roth money, and then make sure you have both primary and contingent beneficiaries. And if you want it to go down the bloodline, there's another thing that we can add on the investment accounts called per stirpes. It's a lovely Latin term that just means down the bloodline. So people a lot of times will forget that. But if you and your brother, let's say, both got left as a beneficiary, but something had happened to your brother, if you don't have the word per stirpes, you would get his entire share. But what if he had had children? You have to think about, would you want that other person's share to go down the bloodline to their family, or do you want it to go to the other beneficiary? So that's another area we see that needs to be kind of fixed a lot. Do you want it to go down the bloodline? Do you want to make sure that the right assets go to the right people in the right manner to pay the least amount of taxes? Make sure that you work with a legal professional like an attorney to draw up your legal documents, and then make sure your financial professional and or professionals, meaning the bank and all of your investment accounts, have the proper language and the beneficiary designation. Because again, 99.9%, we find at least one account that is deficient.
Heather, you're always bringing you're putting people on game. Every time you come here, you're giving some great advice. Thanks for being here. You guys, take a look at your screen right now. You just heard all of that great and important information. Now check out and go ahead and